Kia ora, welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. My name's Frances Cook. I'm the investments editor at BusinessDesk, and we have a great BusinessDesk special for listeners and viewers. You can find out about it at the end of this episode. But before we get started, here's some important information. Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording. Now, today we're joined by Independent Economist Tony Alexander. Welcome, Tony. Welcome back to the show.
Well, thanks for having us again, Francis. Always enjoy these sessions. So, good to be back.
Oh, great to have you. I feel like we always get so much feedback after your episodes, which is a great sign of things. I mean, let's start big picture. Overall economy, it is looking a little hairy out there. I feel like when I'm getting questions from people, they're feeling a bit scared of, all the reporting that we're seeing. What do you think are the big factors that people should know about right now?
Well, the big factors I think people want to know about is when is the cost of living increase going to slow down? The prices of things are just, still increasing out there. Obviously, local authority rates are hitting so many of us at the moment. So I guess people are looking for some insight into when inflation / cost of living is going to go down, when are interest rates going to go down, is the housing market turning around, and obviously of high relevance to managed funds, investments generally, is the New Zealand economy really slipping into recession? Is it going to be a deep one? If we are, when might things improve? And of course, there's this overlay of, it's an election year, so what the heck does that mean? And of course, none of us really knows.
There's a huge amount of uncertainty at the moment, isn't there? Because there's all the talk about recession. We'll, of course, be getting some official stats released similar time as this episode comes out. So FYI team, we are talking about this before we get all that info dropped. But we're also, we've got things like the election hanging over us. That all of this uncertainty has a big impact, doesn't it? Kind of makes people hit pause.
Yeah, that's right. When, especially in an election year, businesses might decide that, they need a new factory, but let's just wait and see what the election outcome will be. Or even in the housing market, people are going, we've been waiting 2 years to make our first home purchase, but let's just wait and see what the election is going to do, because maybe that's going to have an impact. So it definitely does cause people to delay things. And each month now I do a survey of people in their capacity as business owners or operators, and a very large number making comments about the uncertain political environment in particular. I'm trying to be polite there in the way I put that across. But basically, a lot of hate language coming through from the business sector about the government. So, high uncertainty, and that is going to retard, unfortunately, businesses' speed of investing in new machinery and equipment, all these sort of things. So, there's some negatives dominating at the moment.
Yeah, and I also think, the influence from overseas is an interesting one, right? I mean, particularly we've seen some really big things happening in the US. A couple of banks collapsed, although, of course, they have speedily been taken over by other banks, but still those collapses happened, and problems with the debt ceiling. Talk to me about what's happening overseas and what kind of impact do you think these factors will have on New Zealand?
Yeah, well, certainly, first of all, in terms of the quarterly survey that I do with yourselves, where I ask people what their concerns are, very high ratings there that people had for being concerned about the global economy and geopolitics. So basically worries about what's happening with China and Taiwan, obviously the Ukraine situation as well. And for the global economy, I think a lot of what it comes down to is that, number one, China, it has opened up again. The supply chains are functioning a lot better as a result of them finally letting COVID through their population in the middle of December last year. But consumers over there are worried about their incomes. Their bonuses are way down. They're not spending like was previously expected. The orders are not flowing as rapidly through to Chinese factories. So, this is highly relevant to New Zealand, where 1/3 of our exports go to China. And so China's economy is looking relatively flat at the moment. In the United States, there's still a concern that maybe they have a recession, and it's like 1 week they'll get out some relatively weak economic data on business investment, etc., and then all of a sudden they get strong data, especially in the either the housing market or the labour market in particular. In Europe, technically, already had a recession across there, so there's high uncertainty. And in Australia, although there's a very strong underpinning from the minerals, the energy sector, people's electricity bills are rising rapidly over there, and there's still talk that maybe they get pushed into recession by interest rates still being increased by the Reserve Bank of Australia.
There's so much happening at the moment, isn't there? Okay, you mentioned that quarterly survey that you've done for Sharesies, and it is fascinating what you've found. So let's really dig into those results, because it's always interesting when we actually get some hard data to look at. With all of these things that we've talked about, all of these various uncertainties, the influences coming in, my instinct might have been that people would get a fright and stop investing. But in your survey, I think, to me at least, people are not as scared as we might have assumed. What did we see here?
Yes, it's interesting. People are deeply concerned about a whole lot of things, such as high interest rates in particular, inflation, as I said earlier, geopolitics, the global economy. But what we've seen over the past couple of surveys has been quite an increase in the proportion of people who are looking at investing more overall, and especially investing in shares, either directly, going through managed funds, going through exchange-traded funds, etc. And I was just noting down earlier the proportion of people, net proportion, looking at purchasing more shares generally, running at about 92%. 3 months ago, that was at 86%. And then back in November last year, it was about 66%. And I think what's underway here is that we've seen some big recoveries in prices for tech stocks overseas. They had their right sizing staff number adjustment period after the pandemic boom, getting things back in order. There's a feeling that they are better positioned for whatever's going to come along down the track. And of course, just a feeling, maybe more of a hope still, that interest rates around the world don't need to increase much further in the likes of the United States, etc. And so that also encouraging some people back into the share market. But I personally, I do happen to wonder if maybe some of this is a little bit premature, given what people acknowledge is a deep level of concern still about the world economy and that geopolitical situation. But it is at least pleasing people do have that longer term perspective on the value of share ownership.
Yeah, it's interesting, isn't it? Because one of the things that I picked up in the stats there is possibly maybe a slight difference in what people are doing versus what they're feeling. Talk to me about the fact, we're still seeing them putting one foot in front of the other, right? But there is increasing levels of concern.
Yeah, increasing levels of concern, but this is a post-pandemic environment which we have never lived through before. So just as we'd never been through a pandemic before, and everybody on the planet proved we did not know what was going to happen in a pandemic environment, all of our forecasts for our economies were wrong. Because we've not had a post-pandemic period before, it's unsurprising that we're going to be surprised by a few things at the moment. And let me give one example, for instance. Around the world, in surveys such as one I do each month of people's spending plans, people overwhelmingly say, I'm going to slash spending on eating out. But eating out was denied to us at various stages during the pandemic, and we will do what we can to continue to eat out. Cafes, restaurants, maybe just takeaways. There's a disconnect between what we say we're planning to do, what we're concerned about, and what we actually do. And then, of course, there's the thing that people are worried about their economies. Maybe there's going to be a recession. And normally in this sort of situation, you go, well, if you're worried about a recession, you're obviously not going to go traveling overseas, are you? No. That was denied to us again during the pandemic, and we are embracing it with a vengeance. And so it is difficult, I think, to really extrapolate some of the readings that we see in the surveys out there, which means maybe you need 2 or 3 surveys, try and average them out to get a view on where things are going. But I do tend to think that when it comes to the investment side, that a lot of people are prepared to look through what they acknowledge is a very uncertain environment, uncertainty, especially about inflation and about interest rates, and think more of that long-term perspective. And of course, when we were running this survey monthly, I was always asking people about, are you changing your long-term plans, this, that, and the other? Basically, those results never changed from one month to another, and hence we could shift towards a quarterly survey instead. It's a good long-term focus, I think, for most investors. One interesting result is people do seem to be building up some extra savings as well, maybe building up a little bit of a war chest for extra purchases down the track.
I think the savings environment is such an interesting one as well. We'll come back to that point in just a tick. This might be a little bit less hard numbers. This might be a little bit more of reading the tea leaves of what you're seeing, but I'd still love to know your thoughts on it, because we've seen a lot of investors become a bit more sophisticated over the last couple of years, I think. There were people who were investing before 2020, but there was a huge boom through 2020. And then there was a few dips. People sort of got to see how the market can be volatile. They got those first few frights. And so maybe some of this uncertainty is a bit less scary for people than it was even a couple of years ago. Do you get the feeling that people are trying to do things like the hallowed buying the dip, or is there something more going on with it? What do you think?
Yeah, I think it's more sort of the first comments you were making there, Francis, that people have seen the uncertainty of the pandemic, and they have seen either themselves or others make the mistake of rapidly changing their portfolio composition, going from growth funds to conservative or balanced funds, and simply locking in their losses early on. And then, of course, the markets they saw rallied extremely quickly. So I think that's been an important lesson, especially to a generation which has, as a result maybe of KiwiSaver, been getting used to having shares out there and becoming interested in them. And so what I think you've had people doing is they've been watching their KiwiSaver balances going up, but because of their familiarity with what's in the portfolios, they're looking to do some of that investing themselves as well, and then learning the lesson in the pandemic of, this has got to be a long-term focus. And maybe especially in New Zealand, with the disincentive provided to continue investing in residential property to the same degree as before because of the government's tax changes from March 2021. It's like there's a natural pool of money which in the past might have gone, no, it's obvious housing. Now we need to think about something else. And so maybe some of that money has gone into cryptos because we've seen that new asset class come along relatively quickly, and some big ups and downs there. And that in itself can sort of teach people about, okay, if you're riding something rising strongly, you got to allow for it to go down, and then maybe it goes back up again. But yeah, I do believe people have had some good learning lessons over the past 3 to 4 years in particular.
Yeah, this is why I love the fact that people can get started in investing now with less money on the line, because sometimes it really is that learning by doing is just so valuable. Sometimes you have to experience the fright to realize how it can go and how the roller coaster can also recover. I mean, you mentioned there about things like crypto. What other investment types are sneaking onto the radar? Because crypto, gold, these things are also making a bit of an appearance for people, right?
Yes, they're certainly there. I ask about them. Now, when it came to the crypto assets, about a year ago, we saw a decline in the net proportion of people saying they were going to buy the crypto assets. Basically, when we saw the Bitcoin price fall away relatively strongly, people then, they learned something. This can be highly volatile. So we've still got just over a net 4% of people in the quarterly survey saying that they're looking at buying some crypto assets, as widely defined. So they definitely haven't disappeared completely. We don't tend to see too much of a change on precious metals. That surprises me a bit because we've seen gold price up until recently sitting above $2,000 an ounce there, and there's usually not too much change on artwork and these sort of things. Maybe it's just a little bit less accessible for the average person out there, a bit more lumpy, and they don't know what should I buy. They, in that sort of field there. But there's certainly that strong and strengthening underlying demand for the shares, and like I say, not just directly purchased, but also partly through managed funds, an increasing proportion willing to invest there, and then also for the exchange trading funds, the ETFs as well. Commercial property investment, that's always been in there as a sort of relatively strong area people are interested in. But of course, that's difficult for most people to do themselves. They're looking at maybe the listed funds, maybe some syndications. There's some good opportunities that exist out there, or good offerings that are there. But I guess the main thing I've found over the period of the year and a half or so, 2 years we've been running the survey, there initially monthly and now quarterly, is that there usually aren't big changes in the mix that people are looking for in their portfolios over time. And that just says to me, most people are looking at this as a very long-term focused thing rather than trade in, boom, trade out again. But of course, we've all got a desire to do that. And that's where Sharesies offering is quite good, because it can meet that need for people I can easily do a bit of buying here, a bit of selling there, but I might only do that for, 1 to 5% of my portfolio. But the rest, boom, that's in there for a long period of time.
Yeah, absolutely. No, it's music to my ears that it's showing these long-term strategies coming through, because that's people being smart with their money. Absolutely have a certain percentage that you have a little play with, but as long as you're smart with the majority of it, I just think that's great. I mean, what are we seeing in how people are investing as well? Because I think we've seen a sea change in the past few years, but it's maybe settling down a bit now. So what are we seeing on the methods people are using to get their money into the market?
Yeah, certainly there's been an increase in the proportion that are using an app in order to make their share purchases, managed funds, ETF purchases, etc. And I was just noting the numbers again early on. Back in November, I had about 41% of people saying, if they're looking at making a purchase, they'll use an app. February, that was 50%. In this latest survey from late May there, about 53%. So obviously, as time goes by, it's not just the youngest, newest generation taking up the technology out there who become familiar with it. They get older. Awareness of these things spreads into the older age brackets. Now, it's certainly still the case that when I break down the results by age, very large age brackets, there's a far greater uptake of app purchases by the younger generation than the oldest in particular. But I can't help thinking that maybe some of that is going to change over time, especially as, like I say, the attractiveness of residential property is not what it was, and people will naturally be looking to undertake some other investments. And maybe there's also, when we talked earlier about some of the learnings people have had, some people have had some tough times recently, and they've learned that having money in KiwiSaver is a great thing, but getting it out in case of emergency can be relatively difficult. So I think one of the things people are learning out there is KiwiSaver, yep, but also right along beside it, you need other assets there which you can sell if you come onto some hard times or some other opportunities. That's simply not available with the KiwiSaver product because of the very nature of what it's designed for. Retirement, whatever, funding from 65 years of age.
Yeah, 100%. It gives you options, and options are what make life a little more comfortable when it hits the fan. You mentioned property there. I think that's a really important one for us to dive into, because we hear so much about how New Zealanders love property, and of course, historically they have. But how is it comparing right now? Which one are investors more interested in?
Yeah, the interest in residential property from an investment point of view, I'm actually finding relatively hard to gauge. I've got monthly surveys, mortgage advisors, and that survey that I'm doing right at the moment is showing an increasing interest from investors in getting advice from mortgage advisors about what to do. So that's in positive territory. I do a monthly survey of real estate agents that shows first home buyers well into the market for 4 or 5 months now, and increasingly so. But from the investors, no, still generally are backing away. And again, a third survey I do of just people generally, that still shows a backing away from the home investment side also. And I think it's this combination of, as each year goes by, there's a decreasing ability to deduct interest expenses from rental income to figure out what the tax is going to be. And of course, the interest rates are relatively high out there. And so more people, I think, are having to make a decision about how will they adjust their portfolios going forward. And I still find absolutely zero evidence of a wave of investors selling in response to rising interest rates, the tax changes. But I do think that as some of these residential property owners reach into the time period of we were going to sell this property now to help fund blah blah, they're doing it but not purchasing a new property. And that's something I can see from one of my surveys in particular. There's a decrease in the proportion saying, I'm selling now because I want to buy another property. They're selling now and they're going to do something else. And maybe just right at the margin, some of that money is going more into the diversified investments, the shares, commercial property syndication or something like that. Who knows?
Interesting. And is there any difference between residential and commercial property as well on those factors?
Residential is far more accessible for people. The amounts of money involved are smaller. With commercial, people do need to, I think, undertake a bit more education about earthquake standards, the insurance availability there, the availability, longevity of a tenant in particular. You can't just put an ad in the paper and replace a commercial tenant with a little price adjustment relatively easily as you may be able to do for residential. And I've often been concerned over the past few years when people say, oh, residential's hard, I'm going to commercial. I think that's relatively easy. Now, for people with maybe a bit of money who've been around for a while, they do a successful transition. But I just wonder for the average person out there, I think maybe some of my relatives or whatever, maybe not necessarily something they fully understand for what they're going to get into. But again, that's why what I'm finding, I do talks for different groups out there. There do seem to be a large number of people that show up when I'm presenting on behalf about the economy on groups that are promoting either syndicated commercial property, listed, unlisted, commercial property funds. Strong level of interest out there as people are looking for alternatives, quite frankly. And once the interest rates start coming down again, let's say 2024 for that one, I do tend to think generally there's going to be even more interest, not just on the commercial property side, but going through to the share purchases, the managed funds, etc., as well. But that's a story for somewhere down the track when inflation finally gets back down to low levels.
Yes, and there's so much for us to talk about with interest rates because they impact absolutely everything, really, don't they? But just before we leave the property chat, I mean, you mentioned there about things like earthquake strengthening. That's, of course, a really important one when we're talking bricks and mortar. What about things like the recent severe weather events, the flooding, the cyclones? Has that impacted any of the investing intentions there, do you think?
I haven't had any particular sort of indications coming through of an impact there. I think generally it's more of a wake-up call for people who are contemplating any sort of a property purchase. This could be farmland, commercial property site, either existing or for future development, or in particular, residential, that you have to give more thought to what will be the inundation risk with climate change, either the river or the coastal, for instance, or even with some of the lakes we're seeing in the North Island that don't have natural outlets and the lake level is coming up and some roads and people's houses are getting flooded. I do think these things will be making people think about their investment allocation more generally. They may still go into as much commercial property as before, farmland or residential, but the world over, there is going to be a movement away from areas at risk. And it's like we all know what's going to happen. At some point, the insurance companies are going to say, sorry, this we can't insure because it's obvious what's going to happen. If not this year, 5 years, 20 years time. So all I could say to people is, you do have to take this into account because anyone looking to buy your asset, take it off your hand further down the track, will be even more taking it into account.
Absolutely. I mean, we've already seen some insurance companies signaling that move. That's not even conjecture. The insurance companies making it quite clear to those who are paying attention that they are looking at this, that this is in the future plans, and it's not that far in the future. I really do think it's something that people should be looking at quite seriously. On the topic of property prices as well, I mean, there's been some chatter that the worst of the property price falls might be over. Now, obvious disclaimer here, everyone's crystal ball is wonky, but gaze into it for me anyway. What do you think in terms of the property prices? Where are they going?
Yeah, I think we're at the bottom of the market now, meaning we might have hit the absolute price low on average 2 months ago. We might be there now. We might hit it in 2 months' time. You can't tell. You can only tell by looking back and go, oh, that's when it was, back then. So we've got to be careful. But what I do, of course, is I've got my monthly surveys right at the coalface, and so I can see what's happening there. I can see the real estate agents are seeing a lot more people at open homes. The first home buyers are in the market as well. Bank finance is easier to get. The LVR rules being eased, etc. From the mortgage advisors, I'm also seeing again finances flowing more freely from the banks. And so, I can get coalface information on what's happening right now. And right now, the first home buyers are in there. The investors are looking, but they're still pretty hesitant. I can look at one of my surveys, and I think what it's telling me is the owner-occupier thinking of, I will sell and buy, or buy and sell, not yet. They are still, I think, a bit on the sideline. So the first home buyers, they have a window of opportunity which is not yet closed to make a purchase where the vendors are going to be reasonably accepting of reasonable offers, and there's a good range of choice. That's half of my analysis sort of telling me that things are turning. Then there's the longer term stuff. So where us economists really sit, this is the world we really live in. What are the longer term trends out there? And this one becomes relatively sort of overwhelming. And in my commentary for the past 2 to 3 months at least, I've been using 3 words of at some stage. At some stage, people are going to recognize that migration is booming, and at some stage they're going to remember, accelerating population growth. That means more demand for housing. And I can already see the rental pressure is starting to appear there. Eventually that will encourage people to look, okay, well, renting's getting expensive, not as many properties as available. Let's go and have a look at making a purchase instead. So that's one thing, the accelerating population growth. And I just learned an hour and a half or so ago, there's a net migration gain for New Zealand in the year to April of 72,300. It's about a 1.4% boost to the population. It's a total no-brainer what it does eventually to the housing demand. Secondly, this one, been wrong on this one for a while. One day I'm going to be right. I think interest rates have finally peaked. Well, it's more a case
I love
of
the honesty.
honestly, around the world, I'm in good company, at least on this one. I don't think people should anticipate interest rates coming down for a while, but when they do, that is going to have a big impact, especially on activating, is the word I'm using, a 2-year queue of people who have been delaying making a purchase. Initially, they didn't buy in 2021. There was nothing to buy. The market was frenzied, so they stood out. And then people didn't buy in 2022, the residential property, because prices were falling. Why should I do it? At some point, this 2-year queue gets activated, and boom, they step into the market to make a purchase. And then I've got a few other things that sort of are going to be activating the market out there. We've got the number of consents for new dwellings falling away. At some stage, people are going to realise, hang on, the supply of new houses is drying up. And then they're going to remember their first year economics course. The supply of houses is dropping away, the growth in it. Demand for houses is rising. Move those demand and supply curves, and you see what the impact is going to be on prices. There's a few other factors in there, like I say, the LVR changes. But what it adds up to is this. There's a common view that house prices have gone down. That's a good thing. And now we've hit a steady state, long-run equilibrium. House prices are now going to be steady for the next 3 years. Sorry, fluffy pink unicorn environment doesn't really exist out there. I think there's going to be a period of rapid house price gain again. I don't know if we're starting that now. I don't think so. I think maybe it's more after the election. But just the basic demand and supply dynamic from the long-term analysis, that's telling me something, quite frankly.
Yeah, 100%. And I, as I say, I love your honesty in terms of the interest rates, because they've been doing weird things, and the reserve banks around the world have been catching people on the hop. So spot on in that you're in good company with all of us getting a bit thrown for a loop of what is going on here. Do you think we're going to feel a bit more of the impact of mortgage pain? Because the Reserve Bank here in New Zealand has signalled that it's probably done raising interest rates. Let's all just remember that they are more than entitled to change their mind there, but probably finished. But so many New Zealanders are on 1 or 2 year fixed rate mortgages. Many of them will only be refixing about now and feeling that pain significantly for the first time. Do you think that's going to have an impact that rolls through the money world?
Yes, I think so. Point number one, in the likes of Australia, the United States, they're still talking about raising interest rates, and that's partly because their interest rates haven't gone as high as the 5.5% official cash rate in New Zealand. Our Reserve Bank, eventually, belatedly, recognising the inflationary pressures out there, has really jacked the rate up in a short period from 0.25 to 5.5%, and they know that there's a lagged impact. They stressed it again 3 or 4 weeks ago of about 18 months between you change the interest rate and you get the inflationary impact. And they are well aware that with interest rates having increased sharply, frankly, the bulk of the pain on household cash flows has yet to be felt, with over $150 billion worth of mortgage debt to reset from 3.5% or something into 6.5% towards 7%. So the outlook for retailers in New Zealand is not very flash at all for the remainder of 2023 into 2024, because people's budgets are going to be constrained, because we're still going to be having to pay for the groceries, the higher prices there. We've got our insurance costs going up, the rates costs. It does bespeak of a really challenging environment for retailers of like durable goods, furniture and whiteware and motor vehicles. They had a boom during the pandemic. The chooks are really coming home to roost, I think, for some of those, the retailers, the wholesalers, the manufacturers in those sectors for the next maybe 12, 15 months or so.
Now, speaking of interest rates as well, I mean, the flip side of all of this mortgage pain is that savers are finally getting a bit of a break. So what about the savings accounts? We've got the interest rates at these record highs. How are the savers and the savings accounts fitting into the mix of what people are interested in?
Yeah. I mean, yes, the interest rates are better, but then you've got to run your numbers. You might go, oh, 2 years ago, they were only paying me 2%, and now I'm getting 5.5%. And you think, oh, that sounds great. Well, 5.5%, and then you'll get taxed on it. So let's say that comes down to 3.5%, 4% or something. Oh, and then take off the increase in your cost of living, the inflation rate over the past year of 6.7%. You're making a loss, basically. Although you're getting a better nominal return, you are going backwards from that. So although I indicated that people are putting more money into savings accounts at the moment as somewhere to park your money, you're getting a reasonable return, but you're still going backwards. And so that will actually be an underpinning factor for asset prices generally over the next couple of years, as once the interest rates start going down, inflation will be lower by definition as that's happening. But there is still, I think, some money to move into other assets over the next couple of years. The big black cloud is probably still the global economy. If that were to weaken tremendously, then clearly that has implications on share prices, etc. out there. The upside would be inflation would fall away more quickly than at least anticipated. But yeah, the interest rates is a slightly tricky one from a saver's point of view. You think you're better off until somebody tells you the inflation rate. Oops.
Yeah, it looks great on that first line of the spreadsheet, and then you add in everything else and you go, oh, not so much. That sucks. I mean,
Yep.
over the next 12 months or so, what do you think we're going to see in terms of the official cash rate, interest rates, inflation? How do you see all of that playing out?
Yeah, I think inflation definitely coming down. We could already see in a number of surveys business pricing intentions easing off, supply chains are functioning a lot better, materials costs sort of leveling out, maybe one or two coming down as well. We've got the big migration inflow, of course, is going to be many more labourers available, so that's good for business pricing, that sort of thing, with a bit of an offset on the rental side. So I think we can anticipate inflation coming down. There's a view internationally of going from your 7% area down to 4%. Yeah, everyone's going to do that. Getting from 4% to a 2% midpoint, that's completely up in the air. That's why I think people need to be hesitant in believing that interest rates will fall rapidly over 2024. I think there's a very good chance in a year's time, so the middle of 2024, the official cash rate could still be at 5.5%. I know often we think in terms of, if a thing isn't going up, it's set to go down. No, you could stay there at the mountaintop, walking the ridgeline for an exceedingly long period of time. So that's the view I'm running with, that there won't really be an easing easing of monetary policy in New Zealand until probably towards the middle of next year. The speed of decline, I think it's going to be quite a gradual thing. It's hard to imagine that inflation is just going to disappear in a scary fashion of, oh my goodness, we're back into worries about deflation. Remember, 2019, I struggle to see that coming back again for quite some time.
Yeah, totally agree with you on that one. I mean, I'd like to pick up on a point that you made a little bit earlier in our conversation, and this might again be a bit of a reading the tea leaves one from you, but with the older generations getting more interested in shares and picking up maybe some of these apps and using them to invest in shares more easily, with things like the interest rates still in the mix and some of these tax changes, do you think we're going to see some of the older generation that historically was less interested in shares, they might end up diversifying away from property a little bit? Are we seeing that move, or am I jumping the gun?
No, I think we are seeing that move, and especially because of the tax changes, that people are simply not looking at the cash returns. And if you look at the books that have been on our bookshelves of the investing your money, growing wealth for the past few decades, for the residential property, they've always been based around once the price goes up a bit, free up the equity, get another property, bang, bang, bang. That's much harder to do when you need the minimum deposit of 35% of the purchase price now, and you don't have the interest rate deductibility. So I think there's a natural looking away at the other assets out there. And also, of course, the realization that once you take the gearing, the debt funding sort of off the table to a large degree, then you realize that actually that return on housing is actually inferior to the long-term return on managed funds generally, on shares more generally. It's only been superior for most people because you can have your, I used to say $100,000 and the bank's going to be lending you another $400,000, whereas they're probably not going to do that for some share purchases out there. That dynamic is changing. And also, of course, we've got to throw into the fact that people are living longer now as well. So that starts to eat away at the argument of I'm approaching 65, so right, totally out of a growth oriented portfolio, not even balanced. I should be completely conservative. No, I think the investment advisors are increasingly indicating to people that you still need to have a good quantity of growth focused assets in there, because you're going to live longer than my parents or my grandparents and your parents and your grandparents, etc. So I think those sort of threads are running through. And also, just maybe the final one would be from the interest rates point of view. Well, frankly, this is as good as it gets in terms of the term deposits, maybe the government bond yields, debenture rates, that sort of thing. And many people are going to be thinking, well, if I'm maximizing my return at 5.5%, 6%, and then they're going to fall at some point in 2024, I probably do need to have some other assets out there, yielding a dividend, for instance, along the way, with potential maybe for some capital gain.
Yeah, absolutely. All right. Well, bearing in mind that so many people listening to this are making money decisions and trying to decide where to put that little bit of extra they have in order to build for their future. So if they're weighing up savings account, investing into shares, property, all of this good stuff, what do you think is there a main big factor that they need to keep an eye on over the next 12 months or so in order to help guide those decisions?
Well, first of all, gear your investments towards things you understand. If you don't understand it, then that's sort of off your table. If you still want to look at that particular investment, you've got to do a lot of education before you look at it. So that's the overarching, I think, comment to make there. Secondly, to keep in mind would be, I guess, the tracking of the economy. Obviously, if I'm wrong, that recession is sort of a toss of a coin, 50-50, and actually the pullback in consumer spending is quite massive in New Zealand, then that has a pretty strong implication for the profitability of businesses generally and what's going to be happening, obviously, with share prices, offset by the fact that it means interest rates will fall away more rapidly than would be the case. So, yeah, in terms of a big driver of things, it'd pay to keep an eye on, I guess, actual measures of consumer spending in particular. And just recently, we got credit debit card spending for the month, I think it was April or May, and it was, the first negative result for some time. And so maybe the really negative spending intentions numbers I've been getting through in my monthly survey for some time now, maybe finally we are pulling back on the eating out. Maybe we're finally eating our full after not being able to do so for so long in the pandemic. And the trouble is, again, reiterate something I said earlier on, none of us has lived through a post-pandemic environment before. We simply don't know how people react to interest rates going up in this sort of environment, house prices going down. I mean, none of us have lived through a period of house prices falling 18% before, frankly. So there's a lot of uncertain elements out there. But yeah, keep an eye on the obviously the New Zealand economy overall, and we have to wait and see what happens overseas. There's still a lot of uncertainty about the speed of growth in the United States economy in particular and their monetary policy. We might say, oh, US labour market is strong. It sounds like a positive thing, but it could mean their interest rates have further and further and further to go upwards. So we're still in a not experimental environment, but a very uncertain environment.
Absolutely. Well, thank you so much for that, Tony. Really appreciate your insights for today.
Oh, well, thanks very much, Francis, for having us on, and thanks anybody for listening to this.
Oh, yes, always. Thanks for everyone tuning in who took the time to improve their knowledge. Now, if you do listen on Apple or Spotify, we'd love for you to give us a quick rating and review. This really helps even more people to hear about this podcast and learn about growing their wealth over the long term. I also promised you a special offer, and we do have a special offer for Sharesies investors from BusinessDesk. If you use the promo code SharedLunch2023, or one word, SharedLunch2023, you'll get $100 off an annual subscription to BusinessDesk, which is usually $249, including GST. What a bargain! Now, this offer does only apply to new BusinessDesk subscribers, can only be used once per subscriber, can't be used with any other discounts. Enjoy the rest of your week. Stay safe.